So the second one I purchased is Ventus, symbol is VTR, trades on the New York Stock Exchange. It's around $33.74, and Morningstar actually has a 4-star rating on this, and they've got a fair value of $50. So this one's kind of enticing in that the dividend is 3.17, and when I bought it, I'll show the charts in a bit, I was getting over a 10%, I think almost 11% yield. Usually right away, anything over a 10% yield sends off alarm bells, but I've known this company before, so I thought I would look into it a little bit more, and after doing my own research I decided to buy. So I'll just bring up the chart. So you can see here it's actually been a pretty good company. Back in 2009 we got down to around 20 bucks, slowly came all the way up to about 76, and it was in the 52-76 trading range until the COVID-19 happened, and then it just did a nosedive all the way down to 20, well even lower than that, 16. And then I started watching it, it came back, and I ended up getting in at $28. It's now trading at 32, so that's over a 10% return. And there is a possibility, again, this coming back even into the 40s or 50s, along with such a high dividend, you could get maybe 20% returns for some time. I'm not counting on that, but if they can just continue to pay their dividend and the share price can stay roughly where it is now, I'll be quite content getting that 10% yield. So far as some more factual information on this company, so it's basically like a real estate REIT, but you got to be very careful owning now. But I've been focusing my REITs on kind of the healthcare side of things. Of course, staying away from a lot of commercial real estate like shopping malls, that type of thing. With the exception, I have one, but the main tenants are something like Walmart, so it's not, they're not going anywhere. So Ventus owns a diversified healthcare portfolio of 1,200 in-place properties spread across senior housing, medical office, hospital, life sciences, skilled nursing, and post-acute care. The portfolio includes 40 properties in Canada and the United Kingdom, of course United States. And as the company looks for additional investments in countries with mature healthcare systems that operate similar to the United States. The firm also owns mortgage and other loans contributing about 3% to net operating income. So I like the biggest, probably 2/3 of the business is the senior living, and that's why the price is down so much, because of all the issues in long-term care, senior homes, with the COVID-19. And even here it says senior living occupancy, this was in their filings, was at 87.5. It's dropped to 80, which is pretty good. But they say the move-outs, people moving out, is still elevated, and the people moving in is lower than normal, and the occupancy rate they could project by the fourth quarter could be down to 70%. So that's going to affect their earnings a fair bit. I'm just kind of betting this is priced into the stock right now, and hopefully they can turn those numbers well. They have a reputation of being like excellent manager of their properties, and so we'll have to see on a quarter-by-quarter basis what the occupancy rate is for the senior living. Now the medical office buildings, they have small moats for those, because for medical office portfolio it could come from their proximity and connection to top healthcare systems. So given the Affordable Healthcare mandate, which incentivizes coordinated value-based care between healthcare providers and a shift of patients to the types of lower cost consolidated settings that medical office buildings can't provide. So it's kind of saying that the bigger, more reputable medical REITs are probably going to benefit from the Affordable Care Act in the United States. And premier MOB assets generally have three qualities. They're usually locked on campus. So you need that real estate close to a university or a campus, which they do, and or a campus adjacent to a hospital. So there's a bit of a moat there. Getting the real estate close to the hospital or close to the university, and they seem to be pretty good at doing that. Then you kind of got that synergistic relationship. The hospital system is considered one of the top 2 or 3 in a region, and one of the top 100 in the U.S., so they have a fairly high rating. And they are large metro areas with strong population and income growth. So demand for these types of assets will remain strong as patients seek the best treatments from the top healthcare systems, driving consistent patient volumes to their buildings. So that's they also use triple net leasing for about a third, which basically means it's one of the more favorable ways of leasing, is that they pay the mortgage on the building and they have to maintain the maintenance, but everything else within the building is up to the tenants. So their heating costs, if they do any damage within their area, they have to pay for that, and taxes. So it's puts less liabilities on them, on their properties, as they're basically their main cost is just the building itself, and so triple net leases are a little bit more profitable and safer. So again, demographics with healthcare is in their favor. The baby boomer generation started to enter the senior years and the 80+ age, an age rate that spends 4 times more on healthcare per capita than the national average. Should also double in size over the next 10 years. So large, long-term, best healthcare companies will be positioned to take advantage of these industrial headwinds. So, demographics is definitely working in their favor. Now there's a couple of negatives. Somewhat low barriers to entry for the nursing homes, that type of thing. But they do go for longer leases, 12 to 15 years, and then those leases are adjusted for CPI to hedge against inflation, so that helps a little bit. Now they are subject to any changes in the Affordable Health Care Act in the United States. Could be a negative impact, could be a positive impact, but there is that uncertainty. Also, a company like this, or usually any REIT, is 50% debt and 50% equity. So they're very susceptible to deterioration in the bond markets. Right now, an increase in bond yields have been contained, like I just mentioned, by the Fed, corporate bonds. But if if there's a second wave of COVID-19 virus, it may be more difficult to prevent a large increase in corporate bond yields as the whole bond market kind of breaks down. Also because they have so many properties and they sublet to other companies, their accounting is difficult, especially for me to understand. I'm not really an accountant. I've read lots of books on finance and accounting, but still. So there could be something I'm definitely missing. Moody's rates it, their debt at a Baa1, which is investment grade, and it would have to drop 2 levels before it becomes non-investment grade. Their bond, what they're paying on their bond yields is not too bad, 2.7 up to 6.59, and they mature anywhere from 2021 all the way up to 2049. So they do have their debt kind of spread out nicely. So this one I'll just have to see. There's some question marks related to the long-term care and the COVID-19, but I think the yield and its operating history is, makes it fairly attractive right now. I did do a workup on one of my spreadsheets on this, and I did notice for our shareholder retained earnings is negative. I'm not too concerned about that because they pay out nearly all their